So as the two of you, excuse me, have seen things change over the last, let's call it 7 years, give or take, as lending got significantly easier, did that make you guys increasingly more nervous about what was happening, or did it all feel somewhat within an acceptable range of, what properties were selling for and what lending requirements were?
I don't know. It made me more nervous for sure. Like by about 2016, what I was noticing was that in the markets, and John and I are involved in some of the same markets. Actually, we've had properties that were like next to each other.
Yep.
Down in Greenville. But what I was noticing was that, the property prices, the asking prices and the closing prices were just really accelerating. And I mean, I really noticed this sort of 2015, 2016. And, clearly the amount of debt out there had a lot to do with it. The willingness of the banks to lend, the willingness of the banks to lend to newer people, and the willingness of, and at the same time, there was kind of like the syndication business really seemed to explode around that time. I think there were a couple of the big, more prominent syndicators who were out there kind of like starting their armies of sub syndicators and fundraisers and bird dogs and stuff, that suddenly around 2016, it seemed to like hit this, like this inflection point where just the number of people in the business looking at the kind of deals I was looking at, the sort of sub $10 million multifamily deals, just, was like everywhere you turned around, there was somebody who was saying they were a syndicator. So I think those two things happened at the same time to really start driving prices higher. And it did make me very anxious, because I thought, like, the more you're paying for the property, the more risk you're building in, right? The lower the cap rate. People don't often think of it this way. I mean, a lot of people look at it backwards. They say, okay, low cap rates means like this is a bet on the future. People are willing to take lower returns because they can't get returns elsewhere. I look at the cap rate as a measure of risk, and the lower the cap rate for the same asset, not comparing like A's to C's, but the lower the cap rate within the same asset, the more risk is built into that purchase, right? Because you have less of a margin of safety. So what I was seeing was the margin of safety shrinking on deals, and also, the longer we kind of went into it, just, we almost had a recession in 2016. When that didn't happen, and we just sort of built up the pressures in the business cycle, that we knew there was going to be a recession coming, and it was going to be sooner rather than later. So that was making me like kind of anxious about buying stuff.
I agree. I mean, in 2016, we bought 3 deals. All of them, we put long-term debt on it because we said, there's no way, let's go long. Interest rates can only go up. And I remember doing due diligence on a property. We were getting a loan with Arbor, and simultaneously someone called me and said, hey, they were raising like $800,000. We're short $400,000. And I was on the phone with the bank, and I didn't know they didn't tell the bank this. And I said, I'm actually going to help these people out on a deal. We're very good friends and we've known each other forever. I'm going to put some money in. And he literally said, do not tell me that, because the deal's already gone through agency commitment. They can't just swap out a $400,000 equity piece. It doesn't work that way, because it was half the equity. So, but that was 2016. And I was like, it's crazy. Now we continued to like we were looking at different types of deals, but at that point in time, I thought, I've been saying this, I thought the world was ending, right? From 2016, 2017, 2018, 2019, but it sort of hasn't. And, for whatever reason, but I agree. I think we remember we were grabbing a drink in Brooklyn. We were talking, we first, met. It's like, how much higher can it go? Because it's an interesting way to look at, same product, same vintage, A, B, C, whatever it is. And the lower the cap rate, the higher the risk, because people don't look at it that way. And I understand it, because from a standpoint of your margin of error, the lower the cap rate, the more the debt, there's so many levers that you could pull. So it's a really interesting way to look at it that I don't think people truly get, right? There's a deal floating around right now, like a 4.3 cap. And I had a broker email me today and literally said, how can you raise money with presenting that. And it's a lot of money being raised because, it's not, it's a major city, but at a 4 cap range, people think it's an A-class deal, no risk. And that's tough for me. That's tough for me to bite into.
Yeah. And not only that, but I mean, what you see a lot of is people buying deals at a, 4.5 cap, 5 cap, and they're still promising an 8% preferred return. And it's very difficult to make those numbers work unless you're taking a lot of risk and doing like a major repositioning rehab or something, and even then, like, you're taking the timing risk that that the economy is still going to be in good shape when you finish this. There's definitely, that issue. But actually, John, I want to ask you a question. Like, so when you and I first got started, because we got started in this right around the same time and closed same thing for me. My first deal that I closed, like, went into contract in 2013, closed in 2014. At the time I was taking on long-term debt in 2013, 2014, because I thought I didn't want to take the interest rate risk as I saw it at that time. I don't think anybody in the business was saying, hey, 10 years from now, if you think our interest rate is going to be higher or lower than they are today, yep. I think 95% of the people would have taken the bet that they will be higher. Right. And what I would like to ask you, John, actually, is what lesson have you learned from the last 5 years where the correction that everybody was anticipating didn't happen?
Yeah. So I think I'm going to quote a friend of ours, our buddy, Brian Burke. And he hasn't been on our podcast yet. I do have to get him on here. We locked in long-term fixed interest, and I'm not as much, I might have a persona out there that I like to take risks and stuff, but I'm probably the least risky in the office. And I typically push back on a lot of things. The biggest lesson I learned is that obviously no one can predict the future. And there was a chart I saw the other day, I don't know if it was on Instagram or something, that showed like interest rates from the 1960s to now. And there was only like one period of time where it went up. And every other time it's been down, 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 down. Yes, and that's, it's big 10-year blocks. So maybe it goes up and down, enter the 10-year period. But I would say the biggest lesson I learned is that, I think that floating rate options and the Fannie and Freddie, that stuff is, you don't want to hamstring yourself to prepayment penalties that are so big because of yield maintenance and defeasance and all that stuff over a long period of time, because it really restricts your business plan. When we looked at the deals, we said, okay, long-term interest rate at 4%, what's better than that? And meanwhile, now you're getting money at 2.7. So it's like, okay, well, now there's a sacrifice. You're going to have to sell your deal at a discount on a loan assumption or a massive prepayment penalty and a higher price. So the biggest lesson I learned is that your debt is super important. I mean, we're buying a couple deals now, all cash. So we're taking that risk of the uncertainty in the future probably off the table to really get the right debt from the right lender to make sure that the deals really work. Because you don't want to do super short-term 12-month hard money loans, right? Because there's enough risk with the leverage and the interest rate. At the same time, if you are a syndicator and you do raise money like we do, a lot of the upside is based on delivering a finished product and selling. So if you have bad debt on a long-term deal and you've hamstring your sale, you leave a lot of money on the table. So I think that the flexibility of the right debt on the right property is probably the biggest lesson that I've learned, and not engineering the deals to, 80% leverage, making sure you go in with the strategy where maybe the return's a little bit less, but you have more flexibility on the exit, as opposed to getting stuck in a box and then having to deal with the result, with not knowing what's going to happen in 2, 3, 5, 10 years. Because in 2013, who would have thought 10 years later interest rates would be lower? We're not that far away from 10 years ago. Yeah. So it's probably the biggest lesson is just making sure you have a really good idea of your debt and the business plan, and then making sure the debt fits the business plan.
Yeah. I mean, it's funny to look back on it. And what was it, like 2017, 2018, we were seriously considering buying deals with long-term debt at like mid 4s with the idea to sell them at loan assumptions in a few years
Yeah.
because we thought debt was going to go higher and they would be attractive interest rates. And now it's like, deals that were bought 2-3 years ago at a 4 or 5 rate, you're talking anywhere from 100 to 150 basis points above where you can get new debt. So it's like, it's almost impossible to sell. And if you have yield maintenance, like John said, you can't even sell the deal because your prepayment penalty is so massive because the bank has to relend it at a lower rate. They're going to make less money, not even accounting for the time it takes to relend it. It's crazy. I mean, that's the only reason we bought our last deal in Jacksonville at the price we did, is because they're blended. We got a supplemental and the blended interest rate is like what, 4.7, 4.75.
Yeah, it's the first position loan is like 4.85. The second, and now the supplemental is 10% of the total value. It's like 3 and change, but yeah, we have a blended like 4.7 rate on an 8-year loan. It's unattractive, but our basis is great. We're selling a deal, similar situation. There's a property around the corner in Greenville. It's selling for like $125,000 a door. Our deal is selling for under 100 because we have a 4.56 interest rate on it. There's a discount to that. And yes, okay, we're going to do just fine on it. But if we had better debt, it would have been a totally different deal. But that's sort of the nature of the beast and not knowing. And I know I said it before, but Brian does only the floating rate Fannie stuff because you have flexibility. It's a great product, and it's something that we definitely look at now because it just gives you a lot of flexibility.
When you go ahead,
I was going to say what I'm seeing now though is also there's like another issue, and just on your point, John. Like I remember very distinct having this conversation when I first got started. I was working with a guy who had a lot of experience. I mean, like 20 years of experience in multifamily. I was actually working with him as my buyer's broker, right? But he kind of provided a lot of mentoring along the way. And I remember him telling me like, look, you're buying these deals and your interest rate is like 4.5. It's a great interest rate. When you sell, you're going to be able to like sell it with an assumption because somebody's going to want this blended interest rate, where they're going to supplement it or whatever. And they're going to be really happy with like their blended interest rate. So the idea that 4.5%, which was fantastic debt, 7 years ago, is now you're saddled with a 4.5% interest rate on your assumption deal is kind of bizarre to contemplate. But what I'm seeing now though is I've been looking at deals and trying to help a particular client out, and what we've been running into with some of the deals is that they're debt constrained, they're leverage constrained because the cash flow isn't producing enough to meet the DSCR at the price that the sellers are asking, right? So you can just not get full proceeds on the debt, even though the interest rate is really low. You're only able to get 65% or 60% leverage on the deal because it's just not at the price that the sellers are asking. It's not producing enough cash flow to support that, even though they'll lend on it. They just won't give you the full proceeds. So it's just another indication of how the market is changing, and people are responding to this now by sticking on. In the old days, when I first got into the business, there were all these guys running around saying, hey, I can get you mezz debt, right? And we'll get you 93% leverage. And that to me just struck me as like insane. I don't want all that debt risk on my deals. And then, all the lenders said, oh, we're getting, you can't put any more leverage on the deals, right? We're eliminating the whole mezz debt market from like Fannie and Freddie and CMBS debt because we don't want people over leveraged on these deals because it puts us at risk. Now people are turning around, they're doing, pref equity, which is essentially mezz debt, right? Except the lenders on the pref piece can't foreclose on you, right? Because it's equity. So, but we've gotten to the point now where we're back in the mezz debt world again because it's really difficult to make deals work, especially like we were talking before about like buying at a 4 cap, promising an 8 pref. Like the only way you can do that is by sticking in a bunch of pref equity on the deal. So,
no, it's interesting, and so like we're buying a second house. we have an interest rate. We interest rate locked at 2.62% on a second house in upstate New York. So it's like 4% you thought was wow, look at these interest rates. They're giving money away for free. And now, 8 years later, 7 years later, it's lower. But you're right. I mean, financial engineering deals with pref equity and mezz debt, and it just makes you all you're doing with that is putting risk on the table. That whether it comes off or not. Now, yeah, it's equity, and maybe the common equity or the guy below the pref doesn't ever get a check, but that's all that stuff does. And I'm not saying it's not good or it's bad or you shouldn't do it. You just have to understand your deal and your structure, and you have to understand that. And if you're borrowing 50% or 60% LTV, and you want to throw a small second on there or pref, whatever you want to call it, you'll probably be fine, right? It's okay. But the problem becomes people that don't know what they're doing, and they go up and they get 80% leverage and then put a 10% pref on it, and now the deal's got basically one mistake or the market changes a little bit and it's over, right? And then if the sponsor doesn't have any money in the deal, he realizes, well, I'm never going to make money on this property, and then it just goes to shit because he doesn't make anything on it. So there's a lot of dynamics to understand, and those are things. That's probably the biggest, most education that we've got just through this period from start to today is just seeing all different types of structures and saying, well, how could this one go wrong? Or putting a star on and be like, all right, I'm going to take that one back from the bank in 12 months. But it's been interesting.